Global gold rush beginning as central banks and investors move to repatriate gold, buy gold, and move gold to safer jurisdictions. Hi, I'm Marco Byrne, the Research Director of GoldCore.com, your precious metals storage specialist. And today we're going to look at one of the more important developments of recent days and recent weeks, which is the increasing preference for both institutional investors in the form of central banks, institutional buyers, should I say, the form of central banks, and indeed of the smart money retail and high net worth investors internationally. So we're going to look at the developments in this regard. I'm going to share my screen with you because there are some very important developments indeed happening in the global gold market. So you should see my screen there, which is the news.goldcore.com page, including today's market update, 255 trillion global debt bubble. So the mainstream and Bloomberg are slowly catching on to something that we've been talking about for months. And this bubble is set to burst. It looks like it will burst in 2020. I think January could be very interesting indeed, and the year 2020 could be very interesting indeed. But what we're looking at today is actually how the central banks around the world, high net worth investors buying physical gold, retail investors buying gold. The term gold rush is one that's abused and thrown around way too liberally, particularly in the media. And those talks of a gold rush only a few months ago in August, September, when gold prices went up to 8-year highs. I saw headlines in some of the media saying there was a gold rush, and there was no gold rush. There was a slight increase in investment demand for coins and bars, increase for gold ETF demand, but it was from a very low base indeed, and a lot of that increase in demand was from existing investors adding to allocations. It wasn't suddenly like the man on the street was suddenly deciding they're going to buy gold. They're not yet anyway. They will in time when the price does what we believe it'll do in the coming months and years, because unfortunately that's when the man on the street, that's when you will see a gold rush, and the man on the street will pile into gold in 2 or 3 years or 4 years time when gold prices have done what we believe they do, and gold prices begin to outperform all other assets. And unfortunately, that's when your typical retail investor will buy in. But today, there's only a tiny minority of investors have any allocation to gold whatsoever. And again, it is repeat buyers, people who've bought gold or invested in gold in different ways, and they're actually moving up the value chain, and they're moving away from digital gold or from ETF gold or from gold stored in vaults with banks, because they want non-bank gold storage. So that's what we're beginning to see, and you're seeing that in both in terms of people moving to the safety of physical gold, gold coins and gold bars, and also in terms of the central banks who are diversifying into gold, and some of them are actually repatriating their gold. So they want to have their gold closer to home. Possession is 9/10 of the law, so they're actually moving their gold back into their home country, their national country, and they're storing the gold in their own country and taking it back from the Bank of England and the New York Federal Reserve. So there's a bit of a run on the gold bank, shall we speak, as people and nations around the world take their gold back because of these global risks. And the risks are very real indeed, and we keep, the media keeps focusing on the geopolitical risks and Brexit and Trump and trade wars and also the macroeconomic risk in terms of the slowdown of the global economy. But the biggest risk remains, I suppose, it is the systemic risk, but it's also the monetary risk. So the dollar, it looks like it's going to be sharply devalued in the coming months and years. The euro, the pound, all these fiat currencies have very real risk indeed because of the 255 trillion global debt bubble that's set to burst, and the response to that is going to be not the printing of money, but the electronic creation of trillions and trillions and trillions of dollars, euros, and pounds. So let's just look at what's happening. So just in recent days came news of, I suppose, the very big news was obviously Poland, and Poland repatriating their gold from the Bank of England. And, it wasn't an insignificant amount of gold. 126 tons of gold has been bought by the Polish Central Bank in 2018 and 2019, and they've increased their reserves to 228 tons, and they bought 100 tons of gold back from the Bank of England. So it's not just a bid to demonstrate the strength. It's not some silly obsession of Eastern European leaders. It's not some silly sort of, symbolic thing. It's actually they're being prudent. They realize that gold is an important diversification. They have massive foreign exchange reserves, and they want to hedge the exposure of the devaluation of these currencies, which they know is most likely coming. They also know that it's a very safe asset to own, that it cannot be devalued, debased, or confiscated, particularly if you have it in your own country. So that was a very important development this week, which is the Polish Central Bank. They repatriated, as I said, 100 tons of gold bullion, 8,000 gold bars worth $5 billion. They are moved by G4S, the large cash handling and gold bullion storage and logistics provider, moved from the Bank of England to the Polish Central Bank. So that was a very important story indeed. And I mean, it's a huge operation, and people were saying it's historic, in terms of this is very interesting on the G4S website, how billions of gold was secretly moved from London to Poland. And gives the detail of it, has some very interesting photos indeed, including of the gold bars themselves. And we're humbled to play a part in gold history with this operation. So yeah, the G4S themselves are saying that it was a historic day in the gold industry, and it's definitely a very big movement of gold, and so that's a very interesting read, and visually quite interesting as well. So that's Poland, but it's not just Poland. Obviously, we've been talking about China and Russia for many months, indeed many years now, in terms of the People's Bank of China and the Russian Central Bank buying gold in very significant quantities. And the biggest buyers of gold in the world today are the central banks of the world. So they are net buyers in 2019, very significant net buyers indeed, and potentially going to be a record year for gold purchases for central banks in 2019. So that's something we've been covering quite significantly in recent months and years, because it's a massive trend in terms of the the overall demand picture for gold. The people who manage our currencies, the central banks of the world, are buying gold and are the biggest buyers of gold in the world. So that right there, there's a story in that right there in and of itself. And unfortunately, it's a story that's not being covered in the mainstream media. It gets picked up, by Bloomberg, Financial Times occasionally, but it's not percolating down into the mainstream media. So the man on the street doesn't actually know that. And if they did, you would find that rather than buying Facebook and Apple and Netflix and Google and these highly speculative tech stocks and cryptocurrencies and all the crazy things that people are speculating and investing in today, they may be more likely to invest in actual gold. So World Gold Council is showing us central bank net purchases of 156 tons in Q3, bringing total demand to 550 tons. So it's very significant indeed. Recent buyers, Turkey, Russia, and China led the way. So yeah, we've talked about Russia and China, but Turkey, very significant demand indeed. So here we see 2019. We're heading up towards the 600 ton mark, and this is just declared central bank gold demand. There is speculation that some central banks may be quietly accumulating gold and not actually reporting it to the International Monetary Fund. So that's the central banks buying gold, but they're also repatriating gold and moving gold to safer jurisdictions around the world. So we covered that as well in the market update this week. So Eastern European nations are buying and repatriating gold due to the risks to the euro, the dollar, the macroeconomic risks, the systemic risks, and this story is very important because. Yeah, they realize that having gold in their country confers benefits, and they're not exposed, in the worst case scenario, they're not exposed to banks, or indeed central banks in this case, and indeed the Bank of England, and there's the Queen inspecting the official gold reserves, many of which central banks around the world, many still store their gold in the Bank of England for liquidity reasons primarily, and indeed with the New York Federal Reserve. So this trend it's been going on for many years, and it seems to be accelerating now. And many countries in Eastern Europe have joined. The Germans did it obviously and repatriated their gold from New York. It took them a long time to do it, and now we see the Poles have done it. Slovakia, and it's a trend that I think I think it's only beginning, and I think we're going to see it intensify in the coming months and years, and hence why I believe we are beginning to see a run on the gold bank. You know, as these central banks move to take their gold reserve back into their own country, and in effect, you know, become more sovereign, more independent, and take their control back and take their monetary power back from the international monetary powers that be. So it's not just Poland, Serbia, and Hungary, two other Eastern European nations who are buying physical gold as well. And interesting quotation there. Brexit and the risk of a global economic crisis put Slovak gold stored in Britain in a dangerous situation. So it's a very important trend indeed, and one that is set to continue. And this story by Bloomberg actually, I mean, the title was a bit silly because it talked about an obsession, and it's gold is all that nationalist leaders in Europe's East can talk about these days. So it sort of somewhat trivializes it. And doesn't sort of give the story the real, I suppose, respect and gravitas that it deserves. You know, this should be a story that's in the mainstream, and people should be talking about, well, why is this happening? You know, but instead, it's, you know, these Eastern European leaders are dismissed as, you know, crazy nationalist people who are rational. They're almost like irrational gold bugs. You know, so. The historical precedent in terms of Hitler annexing Czechoslovakia is mentioned here by Fico, who's the Slovak Premier, Robert Fico, and he's in effect the Prime Minister of Slovakia. And he also cited the Bank of England's refusal to return the Venezuelan gold reserves in recent months. So what he said was quite interesting. He says, you can hardly trust even the closest allies after the Munich Agreement, Fico told reporters. I guarantee that if something happens, we won't see a single gram of this gold. Let's do it as quickly as possible. So yeah, he's not mincing his words there, shall we say, and I think he is highlighting the very real risk there is that in the event of a Lehman Brothers style financial collapse and systemic crisis, then these gold reserves could potentially be nationalized and confiscated. Where there are large pools of gold in institutional gold vaults that are easily accessible or confiscatable, then there is a possibility, particularly in the largest debtor nation in the world, and the US is the largest debtor nation the world's ever seen, and the UK is a very large debtor nation as well, you know. So it's important, and it shows that there's massive underlying physical demand underneath the gold market, which strongly suggests that gold prices have bottomed or are soon to bottom because of this very strong, robust physical global gold demand, and not just the central banks, but also the ETF demand is very robust indeed. So the bottom line with it is, yeah, keep an eye on it. It's a trend that's here to stay, and not only that, another trend that we are seeing is that people are moving from, I suppose, more high-risk jurisdictions, and obviously Hong Kong is the example of this recently, but there is a movement towards owning gold in safer jurisdictions internationally, and obviously we've been at the vanguard of this, so to speak, for many years, because we've long been highlighting the need to own gold in the safest vaults in the safest jurisdictions, and we've long been on record as talking about Zurich and Singapore as the two, probably the two safest jurisdictions in the world to own gold. And just in the last week or 2 weeks, we moved to advise our clients in Hong Kong to move their gold and silver coins and bars out of Hong Kong, and we actually facilitated the movement of one very large shipment from our vaults in Hong Kong to our vaults in Singapore because of these risks. And we covered it in our recent video here that we released on the 4th of November because we felt it was quite an important story. Sorry, that's not the video. It's the video before that, this one here, yeah. So the reason for this is not that we believe that the gold in our silver was at risk of confiscation in Hong Kong. The Chinese government, that would be shooting themselves in the foot in a very significant way. I don't think they're going to do that anytime soon, if ever. So because the Chinese are trying to position themselves as a capitalist economy, even though they're far from that, but they are trying to position themselves in terms of positioning their yuan as a global reserve currency. And therefore, if they went in and confiscated the assets of wealthy investors storing gold in Hong Kong, it would mean that people would not trust the Chinese in terms of doing business for a long period of time, and it would be highly counterproductive to them in terms of positioning the yuan as the global reserve currency. So our concern was not about the safety of the assets, but some of our clients were concerned in that regard, and we just took the view: if you are concerned and it's giving you sleepless nights, why have that stress, have that worry? So, but it was also about liquidity. We were seeing that there was slightly less liquidity in Hong Kong when clients went to sell. The premiums were not quite as competitive as you would see in Singapore and indeed in Zurich. So, and then we took the view: well, if this deteriorates even further, what's to say in a year or 2 years' time when people go to sell their gold that the premiums could be much less, and therefore you might get a much lower price for your gold and silver stored in Hong Kong than you might in Singapore or indeed in Zurich. So we took the view it's time to move it. We advised the clients as much, and we organized one large shipment to keep the cost down for the clients, and it's been very, very well received, shall we say, because the clients understand that we are sort of watchers on the wall, so to speak. We were acting as, I suppose, people who are keeping an eye on the global situation and evaluating the risks, particularly this jurisdictional risk that we see around the world, and not just in Hong Kong, but we see in London as well. And these are two bastions of capitalism, as one of my clients said to me in a meeting 2 or 3 weeks ago, that he was shocked that these two bastions of capitalism are in the the very uncertain situation that they are. So it basically highlights the need to focus on owning gold in the safest ways possible, and that means fully segregated, outright legal ownership of coins and bars. Because when you own gold in that way, you can do what we did in the last 2 weeks, and you can move your assets very, very easily from one jurisdiction to another jurisdiction, or indeed take delivery. Whereas if you own the gold ETF or certain forms of digital gold, you would find it much harder to do that, and it may indeed be impossible to do that. I think given that the risks are deepening, given the financial system, there's lots of creaks in the system, and the Fed is pumping in 60 to 80 billion per month, and this is in a so-called economic recovery when there's no financial crisis. So I think all the signals are there that we are on the verge of another financial crisis, potentially as soon as 2020, and therefore moving to owning gold in the safest way as possible. It's never been more vital, and you're better to do it in advance. And who knows, this may not manifest itself for another year, 2 years, 3 years, who knows? But I think that the risk is that it will happen sooner rather than later. But nobody knows ultimately. But there's no risk to people being proactive and getting ahead of this, and being a year or 3 years early rather than a day or a week late. So I think prudence is the watchword in this regard, and it's absolutely vital that people are aware of these risks, and they take action in order to protect themselves and their families, and all the hard work that they've done over the years to acquire assets. Gold is a wealth preservation asset, but it's only a wealth preservation asset if you own it in the safest ways possible. It's only a safe haven asset if you own the safest ways. So it's interesting times, as the Chinese say, and just get ahead of it, be proactive, don't lose any sleep about these risks. They're real risks, but by a few simple steps, you can protect against these risks. So thanks for your time again. You can follow us on all the usual channels, on news.goldcore.com, and on Twitter and Facebook, on LinkedIn, and indeed on YouTube. And you can sign up for our market updates on the homepage of our website and receive the daily, the weekly updates, or indeed our increasingly popular podcasts. Thanks for your time. Take care. Bye-bye.